Thank you, Mr. Rondelay. And I'd like to thank Johnny Cho to set up this. And this is actually my fourth time giving information to students. So you're in a very lucky position, as I am. So the agenda for the day is basically I have like a dozen slides or so. Let's basically talk about like, what kind of investments that I'm looking for, the criteria of some of them. And at the end, I'm going to present maybe 3 different businesses that I'm invested in currently that may give you some perspective on how those criteria get applied to those businesses. And feel free to ask any questions if you need to during the presentation time. And you're very welcome to ask any questions you may have at the end of the presentation as well. You can ask me about anything other than what I'm buying recently. Not like, you're going to move the prices of those securities, but just to be sure. So left or right?
How about what you're selling?
Again?
How about what you're selling?
Oh, you will get to know over time. Or do even during the presentations. Selling is not something that I would do often. So my name is Gobinath Balasubramanian. You can call me Gobi. I set up this GB Investments less than 3 years ago, as I spoke earlier. And it's basically set it up as a separately managed account. Anybody know the difference between fund management and separate managed account? Okay. So fund management is a money pooled in one vehicle. It could be LLP, LLC, and there is a manager overseeing that account. And as an investor, you would receive a unit in that fund. On the contrary, a separately managed account is basically, let's say client 1, client 2, client 3, their portfolios are separate. They are the owners for their portfolio. So I, as a manager, only have optionality to allocate that portfolio individually. But as a custodian, like we have arrangement, we can allocate it across the board. But that's the predominant difference. The client doesn't have any units of my fund. They have their own portfolio, which I oversee, which I get paid for in some cases. Say again?
Like DPM?
What's DPM?
Discretionary fund.
It's all discretionary, yes. It's all discretionary. Yeah, I basically operate out of my home, which is not that difficult, I guess, for this business. And just like a few miles away in Alexandria. And so you can find more information on the website. I basically write quarterly reports to my clients, which are all available on the website. I usually talk about how the performance of those funds did and what kind of ideas we're invested in. I usually try to share at least one idea per letter, just to give them a perspective from manager end. They could hear from shortly. So first, I'd like to talk about investment philosophy. You are already in a value investing program, so it's not something very new to you. Basically, I just got the idea from Warren Buffett and his mentor Ben Graham, and I just ran with it pretty much. I was just lucky. I didn't go through that learning mode of a lot of people, trying different things and then lose and then come back to the right way. And I just got lucky. I just found Warren Buffett and listened to it, and then it made sense. I just ran with it. So the principles are this. Basically, Buffett says rule number 1 is never lose money. Rule number 2 is never forget the rule number 1. And Ben Graham's 1934-35, he wrote that basically. It still applies. The investment versus speculation. I'm sure a lot of you know what the difference is. Speculation is you buying something, you hope the price of that thing goes up and down, and you're hoping to profit from that. Investment is something that you're really interested in, the asset productivity, which means you're going to buy the business, and you're not hoping to sell that business tomorrow to you. You're interested in how much the business can generate year over year return. So you're going to be an owner of that business. You just ride through that as an ownership. These are the principles. I talked about the ownership mentality. A stock means a part ownership in a business. Basically, if you have the money to buy the whole thing, that is the criteria that I'm looking for. If I had the money, would I buy the whole thing? So if I'm buying 1% of the company, I'm basically looking for, is it worth buying 100% at some point? So stock means ownership, part ownership in a business. It could be a 1 stock, it could be a million stock, it doesn't matter. I talked about the long-term nature of the business, or interest from my side. And the third one is basically I want to invest in established and durable and proven businesses. I am not interested in, let's say, a high flyer. It could be a really growth potential, but it's still not proven yet. We don't know the durability of it. It doesn't matter what the upside is. I'm just not interested. I'm interested in, to speak of like well-oiled machines. That they've proven the products, the service is necessary in nature, our customers love it, they want to have it. So we will keep doing that as an exchange for a portion of the profit. This is how I choose my investments. So I call it like 3 pillars approach. The 3 pillars that I'm looking for is first is a business. Second is the management. And third is the purchase price, what I'm being offered. The business, I want simple, predictable, I can see the future in some way, some favorable way. And that's what I'm looking for. We can take a look at the particular part of upcoming slides. But just in general, I'm looking for very simple businesses. A product or service that I can experience, that I can hear the other customers' like opinions, how they see the product relative to the competition, and so on and so forth. And the second one is the management. I want the management to be my partner. So the management has to have excellent integrity and excellent track record. Basically, I'm looking for like, talent and trustworthiness. The third one is the price. So if everything's being same, I would want the price to be cheaper as an investor to get in and participate in that business development over a long period of time. So this is what I call it, like if you want to have a good outcome over the end of your investment career or whatever, these are the criteria I think they're really important. Actually, Carl Jacobi, a famous mathematician, said, if you want to prove something right, just invert that problem. Like if you want to lose money, if you actually invert all those criteria that I mentioned, you have a candidate for like a great short selling option or a business which may not have a prosperous outcome. If you want to lose money, you would want a business complex, unpredictable, low return on invested capital. You got the idea. The second one, you would want a management with like shady characters, not so much like track record, and they're not very good in operation. And price, you just want to buy it at any price. These are the best. On each metric, you can find a candidate. If you combine all of them, you have a very, very, very great candidate. So that actually proves that the other side is where the attractiveness is. So we'll spend a few minutes on the business part and the management part and the price part. And the business, I talked about the profit. The business needs to be currently profitable. It doesn't. We're not interested in a business which is not profitable. Especially, I told you about I'm interested in a very long-run profitable business. So I'm just not interested in this year, maybe a year before, year before, year before. Yeah, and that will likely to continue in my view. And the good return on invested capital and free cash flow generative. You know the ROICs, ROEs of the business. Mostly that I'm looking for very good return on invested capital, how the business is being very profitable and efficient. And free cash flow generative is basically the company makes a lot more money than it needed to survive year over year. So they have a lot more money, they can invest it further, or they can give it back to you to an owner as a dividends or share repurchase. So if you need to have those, if you need to have the profitable business, high return on equity, and free cash flow generative, you need to have some sort of competitive advantage in the marketplace to sustain that over a long period of time. Especially if they had it for a long period of time, they seem to exhibit some of these characteristics. What I would call it either the company or product has some sort of brand identity. So customers they know what they're buying. They've seen that the fathers buy it, uncles buy it, they know what they're going for. So they have less inclination to go try something new because it's cheaper or whatever. The second one is the scale aspect of it. The larger the business is, the lower the unit production cost can be. So which means they can charge less than a guy with one store or whatever that may be. So they cannot match that price and still be profitable. So the scale could be a great competitive advantage. So unique assets, it could have some sort of patent protection, or they are located in a region or geography which is very, very competitive for the competition to enter that. And network effects, you probably know about this now because lots and lots of businesses would attribute the profitability or potential profitability to the network effects of social media companies, software companies. Once they are in, you have no reason to go join a different one. Or once you're in, your friend may continue to be in that friend circle, continue to join in. For a software company, if you're going to use Microsoft Word or Office or whatever, and your peers are going to continue to use that instead of like Google Docs, for instance. So those are the examples of network effects. So the companies needs to have one of these things to produce the high return on capital for a longer period of time. And you also need to have some sort of judgment on how likely this will continue. So you need to understand the business, you need to understand the customer's tendency, and you need to understand potential competitiveness about the competition. If there is a one criteria that you're looking for, only one, like a silver bullet, what you're looking for is a pricing power. So if you got a business, let's say your costs are going up, let's say next year, and I can automatically increase the price, you got a really great business. If you think, I don't know what my customer's going to do, maybe he's going to run after the next store. If you think that, you don't have a great business. That is a silver bullet in my view. But some companies do take that advantage and ruin that in the process. They increase the prices so much so the competition can easily come in and give an attractive product at a much cheaper price. So they erode that competition. But in general, if you can increase the prices relative to the cost of goods increases over a period of time, you really got a good business. If everything else is same, I would rather want the low asset intensity, which means asset-light business, which means you don't need to put a lot of money to grow further and further and further. And the low debt to equity and assets, you probably know, like 86% of the businesses who fail fundamentally, they fail because of two reasons. One, they don't have enough money. Two, they don't have enough experience. And if you even dissect that 86%, 85% in that 86% ran out of money basically because they either have financial obligation or they got asset-intensive business that just cannot go on. So if it's one thing you're looking for safety, you'll probably be better off focusing on a company who doesn't have a lot of liabilities. If you think about the last 2 points, a low capital intensity and low debt to equity, they're very correlated. If the business is low capital intensity, let's say, they don't have to borrow a lot of money. The contrary is true also. If they do borrow a lot of money, the business tends to be capital intensive and low profitability. That's why they do borrow money. They're very, very related if you can think about that detail.
Excuse me, Gobi?
Yeah.
Did you have any particular metrics you like to use for pricing power?
Gross margins or something?
You can see that as a consumer in some cases. If you have to apply some sort of thing, like a generic thing, I'd probably look for gross margins, like over a period of time. If the gross margin goes like up and down and up and down and up and down, that tells you that the business cannot increase the prices as the cost of the products increases. That's probably the great indicator if you just want to look at the crude number in one variable. Gross margins is the best way to look at whether the business itself has any kind of pricing power relative to the cost of production. Yeah, we talked about the business aspect. Let's take a look at the second leg of the process, management. I talked about the management a little bit. I want the management to be both trustworthy as well as talented. One without the other is no use to us. They could be talented, they're not trustworthy, what use do you got? They're going to end up with the money, you're going to end up with empty days. I want the management to be incentivized to drive the value, not necessarily through stock options and things of that nature. I want the management to take part as owner, as a co-owner. So when I'm joining, they already are owners. So I'm just a ride along to a large extent. So their incentive is much more tied to the economics of the business rather than their salaries. Nothing wrong with the hired guns, like some executives get hired and all of that. Nothing wrong with that, but in my experience, incentives almost trumps everything else. Incentives do matter. If they're getting like a lot of stock options, a lot of like bonus performances based on some EPS numbers, they're going to do something which is not really good for the long-term ownership of the business. But it's very rare to see a family or an individual founder who owns the company and they would do something like that. So that's called skin in the game. Okay? They really have truly skin in the game. If the company goes bad or whatever that may be, they would really feel the pain. So I'm estimating their potential, or at least the track record, by two metrics. One is operation, the other one is the capital allocation. I'm sure, like, and if you're in the finance group, you probably know about the capital allocation much more than the operation part. If you're in an MBA program, you probably understand the operations a little bit more than the capital allocation. But both are really, really, really important. I want the business to have like historical track record of like profitability, and I want them to be growing if there's an opportunity to grow. And you can see that operation-wise, like, we talked about the gross margin aspect of it. You can talk about like an operating margin if they want to take a look at like how efficient they are in terms of selling their products and services. And the capability in capital allocation. So if you think about capital allocation, there are only two tasks: how to make money, how to invest that money further. Those are the two things. I call it, one is generating capital, the other one is deploying that capital. There are only three ways any company can generate capital. Only three ways. One, they can self-generate, which is called profit. Second, they can issue bond, which is debt issuance. Third, they can issue equity, basically stock issuances, which dilutes the existing owner's stake in the company. These are the only three ways any company can raise money. And raising that money, what can they do? They can do only 5 things, just 5 things, if it's really profitable for the existing owners. They can reinvest in the business. Maybe they have like an associated products and services they can invest in, they can sell it to in a bigger geography, bigger region, go global, whatever that may be. They can buy other businesses. Some cases it could be the similar businesses that they are in, or it could be completely different, like Warren Buffett's holding company. They can buy other businesses because they have the cash, the opportunities there, they can buy it and then they can hold it. Number 3, if they have financial debt, they can pay back. After that, they can pay the investors dividends or share repurchases. That's it. These are the only 5 things. If you make it very simple like this, you can basically evaluate whether the management has done a good job or not. For an example, let's say they've been keep paying dividends all along years, which tells you one of those things. Either they have it, they don't have an opportunity to reinvest in the business, that's why they're giving it to you as a dividend, which imposes another level of tax. And if they're, let's say if they are a serial stock repurchases, and unless the company prices are attractive over the years that they bought it, you can clearly tell the management is like screwing up with like just buying the stock repurchase just for the sake of doing it, not necessarily for the future benefits of those stockholders. You can go one by one and figure out like whether the company or management has done a, I'm not talking about excellent job, I'm talking about a reasonably good job. You can see that over a period of time, especially if you're looking at like 10-year track record of some business, you can clearly see that like operation-wise, capital allocation-wise, whether they reinvested or they gave back the money and all of that. And you can take a judgment on whether they acted according to the shareholders' interest over the period. It's really hard for some businesses with have like multiple CEOs in that period, different board composition in that period. You can't really attribute the results to one. If they have a longer tenured CEOs or board, you can easily see how they acted. So we talked about the business aspect, we talked about the manager-partner aspect. The third, I would say, is the price, which is predominantly the very, very, very important piece of that puzzle. So that's Charlie Munger's quote on no matter how wonderful the business is, you can't pay an infinite price. Basically says like, you need to pay some sort of multiple. It makes sense relative to the potential economics future of those businesses. In my view, I would use about like 10 times free cash flow, price to free cash flow multiple is where I'm comfortable. The cheaper it is, the better I am, better I like those opportunities.
Why you choose this ratio?
Say again?
Why you choose this ratio?
Which basically what I'm saying, 10% is that's my opportunity cost. When I get in, I would want to at least get paid 10% free cash flow yield today, and that can increase over time. Like some people may choose like 8% yield or 7% yield or 15% yield. But in my view, I've looked at historical track records of all those companies and how these really, really great businesses, when they get cheaper, they really get cheap. They don't get really cheaper relative to even 10 times free cash flow. So 10 times free cash flow is some sort of a buffer that I found. Both the business prices don't go further beyond that. Two, it's just attractive to me as an investor to enter in. Initial yield of 10% relative to the bond yield today for 30%. 30 years is 3%, which is a substantial margin of safety as an equity holder to enter into that transaction. But again, that's not set in stone. Like some cases, like in let's say 2008 kind of scenarios comes along. There are a lot of businesses could be trading for 5, 6, 7 times earning or free cash flow in that case. But yeah, if it's 7 times is better than 10 times. So you get 13, 15% yield relative to 10% yield today.
Oh,
Yes.
So,
No, go ahead.
so you have a price like an average free cash flow per share?
It doesn't matter free cash flow per share or for the whole company. Price means market price, market capitalization by free cash flow, or the stock price by EPS or free cash flow per share. Last few years averages. If the business is really, really growing fast, or the business is not really growing fast, the number's not going to change meaningfully. But the business is growing really, really fast, you can kind of see. You don't want to pay really, really high price based on just this particular year's free cash flow. Unless you feel that, or you're confident that that number is going to substantially increase over time, you can be okay paying 10 times free cash flow for that particular year. But in my view, I found that you can see that the kind of companies I invest in, they won't grow to the moon. So the year-to-year free cash flow per share or free cash flow as a whole, it doesn't increase a lot. I'm talking about, it's not even 20%, 20% number. I'm talking about within 10, 15% number.
So other than this ratio, do you have other ratio you want to recommend?
This is just for the price.
Right. So just for the the checking the margin of safety.
Right.
Do you have any other ratio kind of compensate the weakness of this ratio? Do you have any such thing?
Well, we'll go over this couple of the businesses that I say, because the ratio in terms of price, let's say somebody offers you a convenience store, let's say across the street, and they say the business produces 100,000 in free cash flow. Would you want to buy it? And you would actually look at all the risk parameters before you even think about buying that, right? So you will look at all the risk parameters before you even consider the price. Right? If the business is unpredictable, complex, and too much competition, I don't even think 10% free cash flow is enough. So the risk has already been associated and assessed individually. We'll have a slide on what risk means. So not necessarily the price is the only thing reciprocates what risk is.
I was going to ask, how often do you change the allocation of stocks or companies that are in your portfolio for each client? And what would be a threshold limit at which point you change and you don't go with the company?
There are very few, almost no changes. I have a slide on that we'll go over. How do we sell or when do we sell? That'll give you an idea. Yes.
So do you apply this to across the board, even if it's a growth or a value investment?
Yeah. Well, most of the cases, the company is really, really growing fast. They tend to have either almost no free cash flow to speak of, or they won't be trading at 10 times free cash flow. So those companies are automatically eliminated, in my view. So they usually tend to be the value type opportunities that you talked about instead of a growth type opportunity.
Yeah, I was gonna, do you find using this for example, do you find that it works for certain sectors?
No, this is actually very, very attractive multiple. I don't know how many people know, maybe Rodney Lake can talk about what this 10 times free cash flow multiple is. This is extremely attractive number. If you look at the globe today, maybe 5% of the companies satisfy those criteria, even in those 5% category. I would say like 95% of the composition, they usually have some sort of weak businesses or declining businesses, questionable management. They don't have competitive advantage. So if you take care of the competitive advantage of the business and the future potential and the management talent and integrity, it would be hard for us to find 10 times free cash flow multiples. So yeah, I don't care. I'm sector agnostic. I don't care, the opportunities like in oil field services or in a restaurant. I don't care. I'm interested in durable, strong businesses managed by great talent management. I want to enter it when I'm getting paid at least 10% a year. So it doesn't matter whether some people say maybe it doesn't work for some technology fast-growing company. That's true, but I don't have to get into that. That's not my forte. I don't think I can predict those like that kind of super growth, stability, or sustainability over a long period of time. And I don't want to pay 20 times or 25 times free cash flow just because they're growing fast. Anyone else? So yeah, this diversification is one of the important aspects of portfolio management. I don't know, I never worked for anybody else in terms of portfolio management. I have a background in software engineering. I learned investments on my own. I've been investing 12 years on my own. I've been managing 3 years so far for other people as a business. So a lot of people have different views on diversification, like how many securities you can have, how many businesses in your portfolio you can have, and what those are. And what I found out to be, if you really got really, really good businesses, you don't actually have to have 15 or 20, which I do. Buffett says, like, and if you're really good at picking businesses, if you really think about like owning those businesses for a long period of time, he says 6 businesses plenty. But I know that I'm not Warren Buffett.
Buffett owns a lot more than 6.
Well, maybe if he has a smaller pool of capital, I'm sure he probably owns like 6 to 10 rather than 15 or 20. But for that, I have my own temperamental problem. Right? Everybody is different. Like some people are happy with owning 2 businesses. If I can control the business, I'm happy with one business. I am the sole owner of the partnership, the business that I own. 100% of my net worth is in there if you think about it. But these businesses are publicly traded businesses. I am a silent partner. I don't have a say in how the business is supposed to be run, how the capital allocation is supposed to be done. If I'm in that situation, the business is in trouble. Because I want the business manager to know what they're doing, rather than I need to tell them what they're doing. In some cases, we may say something about that we see contrary to the evidence, but usually we're silent partners. So I would probably own about 15 to 20 different companies across the globe in different geographies, different industries, and so on. That's basically to protect myself. Almost any investor, you cannot, as a passive investor, you cannot just own 1 or 2 businesses. I don't even think that's very prudent. But if you are a know-something investor, you're on the board, or you can influence some other policies and so on and so forth, you may be okay. I am not at that point, so I own about 15 to 20. And the second part is, I don't want any one of those, like if I own 3 businesses, I don't want one of those businesses to miss it. Maybe something happens, risk of the company close up, it could be anything, right? I don't want my net worth to decrease substantially because of those one mistake. It could be a mistake from me, it could be something that nobody foreseen. So I don't want to ever go back to 0, or I don't even want to go back to minus 30% for one case. Yeah.
Are those 15 to 20 across each individual portfolio, or
Yeah.
is it across all portfolios?
Well, our portfolio is like similar. Like let's say I have a portfolio for you, I have a portfolio for you. So our portfolio is going to mimic. Like my entire net worth is invested that way. The one guarantee that I make to my clients is, your money is in the exact same case as where my money is. So we're truly on one boat. So if something goes wrong with you, with your investment, I'm going to be the biggest non-beneficiary. Obviously, you're not going to be happy. You're not going to introduce to me new clients. And obviously, I'm going to be losing money because I have the same money in those securities. So we're truly on the same boat. So that's protective for my assets, my family's assets, my in-laws, and so on and so forth. And I don't want that to jeopardize that in any meaningful way. And I want my investors to think about the same way. Otherwise, they wouldn't be my investors.
Right, if you really want to focus your attention, manage money for your in-laws.
Right, that'll give you right incentives. as someone talked about the risk, right? So risk on its own doesn't have any meaning. Risk means like anything can happen to jeopardize that. That's all. But without that adjective or prefix, like any of those, risk could be competition risk. Competition can eat your lunch, or it could be a product obsolescence or service obsolescence risk. The product that you are delivering, it may not be relevant to the marketplace anymore. So without each of those prefixes added to the risk on its own doesn't have a lot of meaning. But in the financial media, a lot of times the risk word gets thrown around a lot. What they basically means is the market price volatility, which I highlighted in the red, so you understand. So interestingly, that is the only risk you cannot quantify or you cannot protect yourself in a public marketplace. If you're going to buy a stock, let's say you bought it from one stock, a million stock. What somebody else is going to do the next day or next minute, what they're going to buy and sell, you have no influence on that. You have no control on that. You already bought your stake, and it doesn't matter what the other guy does. Like, sell it at a lower than what you paid for or higher than what you paid for. That's the only thing you cannot have any control on, or you cannot predict. But almost in every other scenario, you can get to the level of comfortability that, okay, I can eliminate those. Let's take a look at one of those things. Adequate return, we talked about the price versus free cash flow, right? I can buy a 20% or 20 times free cash flow yield, which means 5% annualized yield from today, which may not be adequate to me, which is not adequate to me. So you can avoid that by, I pay 10 times free cash flow, which you can compensate for. And product obsolescence, if the product is some sort of fizzy, fuzzy products, latest fad or whatever, you can avoid that. If the product is not being there for a long period of time, people are interested in buying it or necessary to use it for a long period of time, you can avoid those companies. So you can pretty much avoid anything, everything other than the market price volatility risk. As a common stockholder, that risk, you have to live with it. It doesn't matter if you can or if you cannot, but you have to. Someone asked about the when to sell, how often, and change my portfolio for individuals or if I managed for the whole. If the job is done right, which means I picked a business which got ultra competitive, superior business, very high cash flow generator, very high returns on capital, and the management has an excellent track record of growing the business over a long period of time. And you bought it at an attractive price when you bought it. The best time to sell is never. That's probably the punchline. You could have probably seen many business owners who have gotten rich. They've gotten rich with almost one or two businesses. They hold on to them for a long, long, long period of time. So Fidelity actually did a study a few years ago. Who ended up among their clients with a lot of money in their portfolio? Do you want to guess who ended up, what segment of the population ended up with the bigger portfolio than everybody else? Two segments, actually. People who died who never knew they had the account with Fidelity, which means they didn't do anything. So they bought a bunch of stocks and then they died after retirement. So they were the one ended up with a lot of money. The second, people who forgot they had account with Fidelity. So that talks about the never selling aspect of it, the validity to it, why it is the case. You can always come across financial news saying that the recession is right on the cliff or whatever that may be. But usually that's no use. The macroeconomics is something that we have to put up with. Microeconomics is something that you can work and improve your process on. Yes?
Do you invest in VDR companies?
Yes.
And you think that never sell filter glass sales even though they might have exchange rate risk, interest rate risk?
Absolutely, yeah, that's true. It's a business. I was born in India. I lived in 3 countries so far. So I consider myself a global citizen more than a one country citizen. So I don't care, although I live in America now, maybe the currency fluctuation can impact my net worth and my client's net worth. If you really got a really, really good business, this currency fluctuation is not the one that you want to focus and sell the business because you think, let's say you want an incredible company in India or China, for instance. Both Indian and Chinese currencies got decimated in the last year or so. But the next 10 years, 15 years, 20 years, it's got prosperous opportunities for those businesses to reinvest their capital. So I'd be a fool if I owned a company with just very, very strong business with a capable management. I'd be a fool to sell those businesses just because there is an interest rate risk coming along. I wouldn't do that. So it doesn't matter what the business is. It does matter. I pick those businesses, and I understand those competitive nature of those businesses and the managerial talent. It doesn't matter if the business is in Argentina or Brazil or in UK or in US or India or China. Yes. Hey. Here.
So a question about your 15 to 20 positions, you said
Sure.
it's a good hedge so that one bet that's what went throughout. So let's say that you had higher conviction on one or two positions.
Sure.
Does that mean that you still put 5% in each, or would you go 10, 20%?
Yeah, I said 15 to 20, which is a range. Right. So the same way, each individual business, like, I don't have each one gets like 5%, each one gets 6%. No, because the opportunities tend to be different at different point, depends on the capital that I can come up with. If I had so the first option I said never. The two other options, which will reveal some of those answers. So just because I picked a business at one point in time, which were great, the management were great, I bought it at attractive price, you can know that not all businesses tend to be that way over a long period of time. Business prospects can change and will change for some businesses. So if I'm convinced that the business prospect changes for the worse, that could be the other time to sell. If you had to sell, that would be the other time to sell. And the second instance, there is a better opportunity comes along. Okay, you own a business, for whatever reason you bought it at attractive price, now it's selling at like a somewhat less attractive price. And there is an even more compelling opportunity comes along. So that would be the ideal one. Basically, you can sell one that you like less of, and you can put more in those businesses that you really, really convinced about and got a huge potential prospects.
So then, there would be like a certain percentage of companies that would function as sort of a buffer against that higher risk, but that may have a greater return. So when you look at a portfolio for the 15 to 20, if you look at a certain number of companies that may not have as high a return, but they offer steady payback or like low debt, and then use that in conjunction with the other stocks that have higher growth potential?
No. Those are so many variables that you mentioned. The one is the return the business generates itself. The other one is like you as an investor can earn. You and the business can earn completely different returns. Because the business, let's say, like can have 100 million in capital, they generate 20 million in earnings. What if you paid 150 million for this business? So you won't earn the same amount the business earns. Make sense? So that's completely different. But when I'm talking about me as an investor, let's say I buy this business 10 times free cash flow in that instance. So I get a 10% free cash flow yield. And then the business price gets appraised in the marketplace. It can happen. It can sell at 20 times earnings. That's not something unheard of. But there is another opportunity. When this is trading for 20 times earnings, the other opportunity comes around saying 7 times earnings. So it makes much more sense to switch from this opportunity to this opportunity, because the discrepancy in valuation, given everything else is the same, the safety of the company, the management of the company, growth potential of it, they all look alike, but the price is so out of whack. So you're better off selling that 20 times earning company, buying that 7 times earning company. Because you're essentially saying I'm getting paid 15% annualized yield today, buying 7 times earnings, compared to you're selling that business at 20 times earnings, you're giving away 5% yield, which is much more of a trade-off you would want to make. So the concept that we talked about more in theory so far, we'll talk about something very tangible in terms of actionable ideas that what I have in my portfolio. I'm sure every business that I talk about, everybody has different opinion about it. Everybody has different experience of them being a customer for those businesses. And some people have looked at those companies and maybe they didn't like it for one reason or other, but that's okay. This is to basically give you what I think about those businesses and what I think the risks for those businesses. I think the price that I pay compensate for the risks that are associated with being a business owner. I have 3 companies. We'll talk about each one in a few minutes. How many of you know what company Americo is? No, you do. Yeah. So I put it out there. So now you know. So Americo is a holding company behind the product or service U-Haul is. I'm sure almost all of you probably moved as a student, and either you used or some of your friends have used those trucks. They are self-moving rental trucks or trailers. This company was founded in the 1940s by the founder. Basically, his son is the one who's running the company now. And they started somewhere in Arizona. Started one town, in town, rentals. And then over the years, they bought more trucks, more dealership, more trucks. And then today, they have something 150,000 trucks and 112,000 trailers. And they actually control 50% of the market share of self-moving trucks and rentals. And other than that U-Haul self-moving, they have 3 other businesses. One is a self-storage. If you go rent a truck, you probably have a U-Haul building next to it. That's basically a self-storage place. If you're in the midst of moving, you want to put your luggage or whatever in a few months, but it ended up being 3 years. So that's where you store it. And it's got a great economics behind it, because we tend to live in urban societies. We tend to live in smaller and smaller places, but we have so much accessories to speak of. So they ended up being in that. If you got ski equipment, all the summers, you're going to think, summer they're going to stay over there, winter I'm going to take it. And then 3 years later, you're going to figure out, I haven't been to skiing yet. But those are the trend seems to be that. The economics are really good because you get really small price to pay those, to store those things. They're usually within a 5-10 mile radius if you're in the city. So they got good economics on that. And they have about 1,450 locations. They own the locations in most cases. And they also have 2 different profitable insurance businesses. One is a property and casualty business. So if you're renting a truck, they will usually ask, do you want the insurance with it? In almost any car or truck you would rent. But in almost every other car rental company, the insurance part is basically done by somebody else. But in this case, they have an in-house insurance company. So if you're renting a truck from them, they'll underwrite it. They have the insurance company themselves. That's a very, very profitable company. They haven't lost money in the last 50 years. That just gives you an idea of how good they are in underwriting or investments. And the second one is a life insurance company, mostly for selling annuity products and things like that. But it's not in a bigger value in a picture like a huge company, Americo. So I probably talked about a competitive advantage. Let's think about it for a second as a consumer. You're going to rent a truck, let's say once a year if you have to move, or once in 2 years you have to move. What kind of criteria are you looking for? Anybody? If you're looking for a truck rental, what are you looking for? Cost? Convenience?
Multiple sizes.
Variety of trucks? So U-Haul has 21,000 locations you can rent it from. And they only own about 1,800 locations themselves. So basically, how the business was built is they only bought the trucks and they go to the convenience store. Hey, look, I got the truck. And if you want somebody to rent the truck, I can put it there. You can rent it. We share the revenue. You take 30%, I take 70% since I want the truck, and you facilitate the transaction. So this is how they started. And every year, the number of, let's say, dealership grows leaps and bounds. Every time it grows, let's say some company that you like and the prices are cheap or whatever it may be. You don't want to go 10 miles over there because these guys, another gas station over there, that have the U-Haul truck. You know that trucks are identical in nature. The purpose is the same. It's not going to be widely different. And the company with the largest fleet, they can move the trucks wherever the opportunities are. Compared to the competition, they're probably in one location. They can move the truck if they need it elsewhere. So in terms of the price and convenience and the variety of fleet utilization, they got an incredible advantage. relative to the competition. And the price, by far, they are the cheapest because they have so many trucks, they can spend their time on utilization rather than increasing the price, which works great for both of us, which means both the business owner as well as the consumer. So the consumer gets more and more and more benefit relative to the competition. Yeah, yes.
Does real estate kind of tie into that too? So some of
Absolutely.
the property they have today?
Yeah, they own the location. They usually the location that they own the location, they own the truck, and they own the self-storage location right there. So some cases, like people take the truck to move the stuff from the storage location to their home or back. Some cases, and some of the real estate, they've been bought like in the 1970s. So the operational cost-wise, they are in a superior advantage relative to almost anybody. It's incredible. It's stated in the historical cost in balance sheet, but if you have to appraise it in any decent manner, the values are tremendous. But they are necessary for the businesses to run. That shows up in the profits over time compared to the competition. But they are in the business for 72 years. So you've got the depth of the managerial talent, the use of the products, and the information about what the people are using it for, how they can price insurance and so forth. And we talked about the reach. They're unparalleled in US and Canada, extensive distribution. Combine all of this, they have excellent financial discipline. Because the business makes money, they don't have to borrow too much to grow the business. Those, in my view, are a predominant competitive advantage, but I'm sure I can share several, but we don't have time for that. So that's the business aspect of it. The business earns 20%, 25% return on equity today. The return on assets are actually masked by the vast insurance subsidiary assets and liabilities. That's why the return on assets tends to be poorer than it is. The company is controlled by a family called Schoen family up in Arizona. The guy's father who founded the business. And the company is founded now, or around their son, now, and the employee stock options program. They own about 50% of the company. So the employees and management's welfare is directly tied with the shareholder. And they don't take a lot of salary, or they don't take a lot of stock options or anything like that. The stock number remains the same for the last 20 years. That gives you an idea of they don't want to dilute it because they are owners themselves. And the valuation, the stock is today traded for $360, approximately a market cap of $7 billion. They have a net debt of about $1.2 billion. They earn about $700 million. They earned $700 million last year. This year is going to be a little bit higher because of the tax reduction from 35% to 21%. So that's going to improve the earnings. But I didn't even use the current potential earnings. I used last year's earnings, just to give you an idea. So basically, the company is trading at 10 times earnings today. And I bought it over the years, the last 2 years or so. Yeah, I would continue to own as long as the business continues to profit. And every time they build a new location, they're building a moat. Basically, the competition cannot come close. Every time they're building a new location, self-storage, the occupancy rate's at zero, starts at zero, but it takes 5 years to get to 80%. When they get to 80% occupancy, they generate 20% return on capital. It's amazing. The results are always lagged by a few years. So it takes a few years to show what they invest in today. So as a long-term owner, that's the kind of thing you're looking for. The future seems more prosperous. And that's the EBITDA number that I put it, and I'm sure some of you look at the EV to EBITDA number as a valuation multiple. In a lot of cases, it doesn't make a lot of sense. I'm sure Buffett talked about the difficulties of assessing EBITDA because the interest and depreciation are real expense, so they just cannot be taken away as some sort of a valuation crude multiple. So that's the first business. Let's take a look at the second business. Anybody knows this company?
Yeah.
That's good. Are you from Mexico by any chance?
I'm thinking of a different IBA. My wife works for an IBA proton therapy company based out of Brussels. Sorry.
No. Okay, so no, anybody from Mexico? Any Latin America? No? Okay. So this company is called Industrias Pachoco. They are the largest chicken producer in Mexico. The largest is understated here. So they have 35% market share compared to the second largest market share company has like less than 5%. So you're talking about 7% bigger than the second largest guy. Second largest guy is not some junior business. They're actually Purdue Chicken. You probably heard about Purdue in the US. They have a small subsidiary that they have in Mexico. And this business is out there for like 65 years. The family controls the business. And they, 5 years ago or 6 years ago, they started saturating the market share in Mexico. So they're starting, in some cases, they're buying out chicken producers along the lines of Mexican border in the US. So that business actually has grown significantly in the last 5-6 years. So they have about 25% sales coming from US now. 6 years ago, they were zero. So they have huge market penetration. They cannot grow anymore. Think about it. People are not going to wake up tomorrow, oh, I'm going to eat like a 20% more chicken today compared to yesterday. So the chicken consumption is not going to grow that fast. But they can grow into different geographies, which they are excelled in selling the product, cultivating the product and services over 65 years. And yeah, if you look at the number of pounds, that makes me sick. They go through 11 million pounds a week in Mexico. And about 3 million in the US a week. It's a lot of chicken.
There could also be a complementary healthcare opportunity.
Yeah, they are one of the integrated chicken producer you can find. They make eggs from all the way to, if you buy a grocery store like ready-to-eat chicken products, they sell it all the way over there. You can sell it from like a quarter chicken, live chicken, all the way to ready-to-eat meal chickens. So they're very super integrated chicken producer in Mexico. But in time, anybody with a competitive advantage, they can build that. And just to give you the perspective of the 35% market share, if you're going into a grocery store, you're buying a chicken, you're very likely 1 out of 3 chicken that you buy are from them. That opens up some eyes. They have their own large self-production capability for feeds, and you can see that with the 35% market share, incredible network, geography, distribution, reach, and you wouldn't believe the financial discipline that the company has. We'll talk about that in the evaluation. So the controlling family, they founded the company and they still own it about 73%. And so only 27% of the company is float. If you want to be an owner, you can be, and I am one of them. And the company has $700 million in cash, no debt. The company is trading for $2.8 billion, which means the enterprise value of the company is from $2.8 billion. They generated earnings about $265 million last year. And if you look at the return on equity, if you exclude the cash, they make about 25% return on equity. This is not just for 1 year. This is for continuously for 5, 6, 7 years, 8 years. So some of the valuation numbers, what the stock is trading at, what the profits are, and what the price to earnings or price to free cash flow is. So if you exclude the cash, the company is trading for 8 times earnings, which actually means 12 times, 12% initial yield. It's much better than what I look for in general. In some cases, I buy something, 2 years from now, the price doesn't move, but the earnings have moved a lot. So if you look at it from that perspective, you're actually getting paid a lot today than 2 years ago, which is supposed to be the case if the business is growing.
What do you mean by excluding the excess cash?
So the cash on the balance sheet is not used to produce any of those profits. So if they want it, they can give it back to you as shareholders. Like a lot of companies don't have cash on the balance sheet. They usually effectively use it, or they borrow a lot more money than the cash that they have because they call it like financial engineering. It's optimization of balance sheet or whatnot. But they have excess cash. If they want it, they can turn around tomorrow, they can give it back to you. It's to you. It's to us as shareholders.
So you add it or?
It's like you're buying a convenience store. In the cash register, they have $100,000 in it. If you're buying the business for $100,000, let's say, you're buying the business for free because you can take the cash register money and put it in your pocket. There are no financial obligations. So what would you do in that case? Deduct it or add it? So this is the third company. This is in UK. Since you don't know the company in Mexico, I'm hopeful that you will probably know this company. Anybody? They own two different subsidiaries. Premier Inn. Anybody stayed in UK ever? You know Premier Inn, by any chance? Good. So they control 10% of the market share in terms of the affordable hotel industry. And they own a different brand called Costa. If you're almost anywhere other than US, you probably have seen the Costa coffee. They're all over the world. They have like 6,000 branches. And the majority of the branches are basically franchised. Unlike Starbucks, they run all of it. So basically, if you want to be a franchisee, you can apply and you can get your own thing, and they'll set up everything for you. But you put the money, you work for it, and you pay a royalty to them. It's extremely attractive business.
I prefer new.
That's fine. It's okay. There are 7 billion people in the world, and they only have 6,000 stores, and they got plenty of customers to go after. So interestingly, they agreed to sell that, actually last week, they agreed to sell that Costa brand to Coca-Cola. Coca-Cola wants to buy them, and they bought it for almost $4 billion pounds, 4 billion euro, 4 billion pounds. So now they're going to end up with only hotel brand, and they're going to be mostly in the UK, and they're recently emerging in our largest grower in Germany now. And competitive advantages. Look at the company started. They started as a brewery in 1742. They morphed into hotels and restaurants now, along with the coffee brand that they purchased in 1995. And they have 70 years or so in the hotel industry, wide brand recognition, given the 10% market share. This company is noted for highest value for money in terms of business customers. If you're a business customer, you travel around in Europe, you end up staying in the UK, and this is the highest value for money ordered by the customers. And they don't pay anybody to sell the rooms, like a price line or anything like that. They sell their rooms in their own website. So 90% of the bookings basically comes through them. So they don't have to pay anybody. So marketing expenses like ultra cheap compared to almost any other hotel that you can think about. Very dense network. And they own about 750 hotels with like 72,000 rooms. And the interesting part is 500 hotels are they wholly owned, which means they own the real estate in prime locations in like London. Extremely attractive. But obviously get dictated in the profits because they own the asset, they don't have to pay anybody, and it gets high return on capital because of that, because the properties are understated on the balance sheet. So the return on capital, unless the company is a franchisor, like a Marriott or Hilton, somebody else owns the hotel, and these guys franchise it, and unbelievable to get 13% return on capital. And they can because they own the land, so that makes it very attractive to raise the return on capital. The land is carried on a very, very low pace. Actually, if you look at their annual report, page number 47, 48 or something like that, they say what the value of those real estate could be. They valued anywhere from 4 to 5.5 billion pounds. It's so funny, after this transaction goes through, Coca-Cola buys the whole company is selling for 5 billion. And the real estate alone is worth 5 billion. And this company is going to be generating, other than that, the company is going to be generating about 600 million or so in cash flows. So the Costa Coffee has been a tremendous performer in the last several years. You can see that from the return on invested capital close to 50%, which talks about the franchising business model. You don't have to put up the capital or execution, somebody else does. You facilitate those transactions. And yeah, you look at the valuation, they're trading for 13 times earnings today, but after the transaction goes through. Basically, Costa Coffee produced about 150 million in free cash flow. that is sold to Coca-Cola for almost $4 billion. So they sold it for really, really, really high price, and which is going to bring down the PE of less than 10 after the transaction goes through, if the price stays the same. So yeah, these are the businesses that I own, and you probably would have seen some of the characteristics get applied to those stock selections. And if I had done the job right, I could see the results over time. Whether I've done the job right or not, I could see the results over time, which can prove that whether I've done the job right or not. And if I'm right, I would probably like to own these businesses forever, as long as the business don't decline or I don't come across anything more attractive opportunities than this. You can ask any questions. Yeah.
Can you talk about your idea generation process?
Yeah, over the 12 years, it changed a variety of ways. In the beginning, I started investing as a quantitative investor, mostly like a Ben Graham, because you could see that early wannabe investor, they lack the judgment of the qualitative factors of the business. So I used screeners a lot in the beginning of the career, let's say 10 years ago, 12 years ago. But over time, you're looking at every business model that you come on. I probably looked at a few dozen companies in the last 12 years. Some companies just jumps out to you in terms of qualitative aspect. I still use screeners time to time now, but mostly now I compiled a bunch of ideas over the years because I analyze, I like the business, I like the products, I like the management, how they run it. One reason or other, I didn't buy it because the price is super expensive relative to what I think is worth or what. So I put it in those piles. So I nurture those. I go through like hundreds of annual reports every year, learning about what has changed relative to what the history has been, and why that could be, and why something could change dramatically, better or worse. So right now, I would say I do less and less screening, but I read a lot of sources, and I admire a lot of investors and management, and they make investments and they comment on investments. Let's say, you and I talk for a few hours. I'll probably ask about what is the best business that you've seen in your life, and then I learn about it if I did not know about it. If I liked it enough, I'd probably learn further and then I'll put it in further. Time to time, this business, Wig Bread, I was able to buy it last year because of the Brexit happened, and they thought the UK business is not going to go on forever. It's going to decline forever. But that's not a UK only business; it's a global business, and would have 10 times the earnings with a real estate value of $5 billion. It's so attractive. And 2 years ago, it happened with the chicken producer industries with Choco, because they were planning to buy a U.S.-based producer, and they were not sure how that transaction is going to look like. But even that's a complete total disaster. You paid the price for a really, really good multiple. In America, actually, that's the recent purchase, I would say, within last year or so. But I probably known America for 12 years now. And I have moved 4 times in the last 10 years. And 3 times I used U-Haul trucks. So you can see that I'm a value guy. I'm looking for cheap products and services. And I looked around. And one time I decided to go rent in a different place because it was much cheaper. Alamo rental maybe, something. And then this is just like an airline industry. They usually sell it more than they have. Then you go and see them, they say, we don't have it. It was supposed to come right now, but we don't have the truck. I was like, no, I have to move right now. There's movers waiting in the garage. So in that case, actually, I ended up going to U-Haul to rent it. So that gives you an idea of how necessary these products are, how these guys are situated to serve the customers, even though, let's say, I'm not an ideal customer to go to them. So over time, you develop those qualitative aspect of it other than the quantitative nature of it. I mean, I'm not saying one is superior to another, but when you combine it, it can work magically. But yeah, in terms of opportunity, I just look around everywhere. Right now, I'm looking at a few companies in Turkey. because Turkey is going through trouble because of the lira devaluation in the world. But you can almost say that there are few strong companies in Turkey. Their earnings are coming from non-Turkey. Right? So I'm looking at a few companies. We may end up buying a few of those. But yeah, the opportunity is basically driven by the market psychology and whatnot. And sometimes I'm prepared to take those. Sometimes I just prepare it after it happens. In this case of Turkey, I never looked at the Turkish company before, and this is the first time I'm looking at it. There are a few promising candidates, but it's too soon to tell. But it's going to be useful 5 years from now, because I looked at a bunch of companies I couldn't there. For whatever reason, I'm not comfortable with the management. I'm not super confident about. If it's a US-based company, I would have a track record. You can basically know about the management in so many different ways. You can do the same thing in some country like Turkey I've never even been to. So it's kind of a qualitative aspects I lack it. But in some cases, if the company is trading for 1 time's earnings, sign me up. Yes.
I have a question about I know you talk chicken before.
Yeah.
But the turkey you say is pretty cheap. So is Sanderson Farms, so is Beach Pride.
Yeah.
So the market is obviously having a different opinion about the prospects of some companies than others.
Yeah.
And a lot of times when you find these companies cheap, it's because they have some hair on them.
Sure.
So when you look at a company like that, are you just thinking further out than the rest of the investors, or would you say that you're looking deeper so you're finding something that other people are doing?
Actually, I say both. The looking deeper in the sense that they are anything but, like in terms of competition. Tyson's is the biggest producer of chicken in the U.S. Purdue or Sanderson Farms, they're much smaller in size. If you look at their return on capital and the margins, Tyson's are much bigger than Sanderson Farms, and the nature of the business is incredibly different in terms of a number of products that they sell, the depth and breadth of it. I would say Pachoco is pretty close to Tyson's than Sanderson Farms or Purdue Chicken to a large extent. In terms of qualitative aspect, they're ultra superior. And a lot of people are concerned about the management owns a high stake in it because there are not lots going to happen. People are not going to get bought into it. Right? This business are not going to be for sale. So some cases people get turned off. They want action. If you want to buy a stock, they want the stock to go up a year or 2 from now. They are not thinking about, I'm a business owner. I'm buying this as 8 times earnings with a loaded cash, getting to be deployed at any point. We don't know where those point is, but I'm okay wherever that point comes along. If they don't see it, they will return the cash as they have done in the past. So that's a qualitative aspect of it. The quantitative aspect in terms of a timeline, I don't really care what the other person thinks. Let's say Peter is the other person, and Peter thinks I don't like this, I don't like this, I don't like this. That's okay, that's you. This satisfies my need for the safety of my principal and the adequate return over a long period of time. So you and I are a completely different person. That's how I think about market participants. I am there to take advantage of anything which is going for me. I don't care why. I'm not going to scrutinize why this guy is selling this business 5 times. I don't know. Maybe you found a better business elsewhere. Maybe you need the money for something. Maybe you don't think the business is going to succeed in the next few weeks or whatever. I just don't care. All I care is, am I buying in a strong enough business? Am I buying with the right type of management? Am I buying at an attractive price relative to my needs? And if I had the money, would I buy the whole thing? That is the key question. If the answer is yes, we don't have to ask any more questions. Yeah.
So you mentioned you work from home. So
Yeah.
Do you have employees?
No, I'm a one-man wagon.
So you handle the accounting, taxing?
The accounting and taxes all are done by the outsourced job. So my job is basically to read and develop the ideas and execute on those ideas. The custodian and other people take care of the accountings and things like that, administrative tasks.
Okay, but for sustainability, as a one-man show, how would your investors be confident to give you?
You should ask my investors. I think I don't know what you mean by that, sustainability. Let's say if I get hit by the truck or something.
No, not hit, you just decided to leave the business. Or
Yeah, they can take the money and go. That's happened with many fund managers, you know. Things happen, maybe they're well off and they don't want to deal with the clients. And sometimes the clients could be pain in the butt and they don't have to deal with it. And a lot of people have closed shops. And the investors will take the money and go elsewhere. But they could see that I'm in terms of career-wise, and they could see that I invested 100% of my net worth on those same things. They could see it, and it's basically up to them whether they have the confidence and comfortability to invest with me. And they could judge me on the talent part and integrity part, and maybe some people just don't want it to do with me. You know, maybe you could be one of those cases, like I want 10 different layers of management. That's why I'm going to get comfortable with that, with the selection of the securities and execution. But probably they're not the right candidates for me as a client. Yeah. So when I started, I mostly started with people that I know, mostly family and friends. Basically, I started with my money to speak of. Over the last 12 years, I saved up and invested in equities and so on. And I thought of working for somebody else, and I couldn't find somebody that I admire who can take me on. So I was like, and I would tell myself, I admire myself, why should I work for me? So I started doing it myself, and initially, mostly the friends and family, they come in. They come in not looking at the qualitative aspect of whether how good I am an investor or whatnot. They probably know me talking about stocks all the time, so they probably seen the energy behind it, and they probably don't want to talk further. But just give me the money, here's the money, like leave me alone in those cases. But now I'm getting more and more investors through my existing clients. So I get introduced to people, and my letters are online almost 2.5 years. So I share the results, I share the ideas, thought process behind it. In some cases, I don't even know how this person finds me, and he calls me and then say, he wants to invest. I was like, do you even know who I am? Like, yeah, I know. I have no idea. I have no idea. This person calls me from New York. And yeah, that's one of the peculiar cases. They say, like, we know enough about you. Like, we've read your letter for 2.5 years. I listened to your podcast, which I participated in. So I don't do any sales pitches or marketing, if that's what you're asking. Which I lack the resources in one case because one my job, I really want to do it in terms of researching best possible business ideas. And two, I don't have money to spend. Potentially they would join at some point. A lot of cases you would get wrong clients. I can sign up with a marketing firm. They will market my fund and whatnot. And they will usually go with the returns of the past. And let's say I have a great return, they just want to pile in, which may not be ideal for me as them as a client. So I want the client to know comfortably that we would go through a period which are not going to be attractive relative to market return. So they would need to buy into my process rather than my results. Results are proceeds of the process and objective things that I do in terms of day-to-day.
What did you say that was your background before you started the finance?
Yeah, I studied engineering, electronic and communications engineering, computer science. I started as a software developer out of college, and in India actually. They moved me here to take care of the offshore team, and I worked here a couple of years, and then that was the first time I ever had any money. So I wanted to figure out what I have to do with the money.
Have you ever used any like technology models to do the quantitative analysis on the companies, like building the software models to help you, or you were analyzing company by company, just going through all of the data?
Interestingly, no, not much. In the beginning, I tried, but all the data that you find are in the past. All the value is going to be in the future. So the past may give you, especially if you're looking at a rigorous computerized algorithmic analysis, you're not talking about one by one. You're talking about a bunch of companies. You want to read through in a systematic way somewhere. You can still do that today. I've done that. I talked about the screeners aspect of it in the beginning. But I don't think today is that much useful to me, unless I'm a fast-paced trader in terms of algorithmic way, some sort of systematically identify underpriced securities and constantly turning the portfolio over. It could work. I have a software background, but I think in terms of temperament, I don't think I am that person in terms of buying in and constantly churning the portfolio. Which one is much more laborious than you think? Two, the results are much more less ideal than you think, because I look at all those statistical quantitative hedge funds. The results are not what I hope. Yes.
So you mentioned that your primary job is to read, develop, and execute ideas. So what are some of the economic indicators you'd look at when you're doing that due diligence and research?
Yeah.
And what's your short take on the economy today?
Yeah, the second part is easy. I don't have one. Because macroeconomics is a fantastic profession if you're going to do it as an economist in a major firm. But it's really hard to have an opinion about macroeconomics and apply that into an idea to make a profit investment. I don't think I could do it. I've looked around. So many variables, it's so unpredictable. And one is the variable itself is so unpredictable. Two, to take that output and apply it into some sort of strategy to outperform it. So if it's too complicated to figure out, I don't have any edge doing it, I don't participate in it. So macroeconomy is something that I said before, something that I put up with. As long as I hold the right type of business, they can thrive in any kind of environment. Actually, I like the businesses economy may go into recession, because the companies that I own actually gets benefited if they go through a recession, because a lot of weak competitors gets washed away and they become stronger and stronger. That's in some sort of evil plan that I have. But in general, I don't care. I'm okay if the economy does well. I'm okay if the economy doesn't do well. In terms of economic factors, microeconomics, I look a lot on those businesses that I want to own. But that goes into a long process of, if you don't know the business in 5-10 minutes to make a deeper dive, you're not going to know in a day or two. It's a long process. Yeah, well, let's go with that.
So, kind of off of that question, so do you believe in an efficient market or an inefficient market?
The market is completely inefficient. Otherwise, I wouldn't have a job.
Okay,
If the market is efficient, I wouldn't have a job. So is Warren Buffett.
I read an article yesterday about within kind of the investment management space, you have a lot of traditional value funds or whatnot, like Paulson and Greenlight and whatnot, that are basically facing withdrawals and moving over to the quantitative funds like Renaissance and whatnot. Your comment around studying some of those funds and their returns, I'm curious your perspective on that. Do you think that's kind of a fad? Do you think that's a trend the market's going in?
This is not something new. This goes through stages of, especially the bull markets. The people that you mentioned, David Einhorn and Paulson, they operate in a model called long short. So they pick a bunch of businesses to be long, and they pitch a bunch of short sell some of those businesses, and their idea is the long will outperform, and the short, if there is a macroeconomic downturn or whatever, this is going to get outperformed too. But the macroeconomics doesn't get to that point, so they're always losing money on the short. And even though the long hasn't done any useful thing for them either, so they are pretty much banged on both ends. But it's natural if you have a bad year, 2, 3, 4. We're all human. The people who are investors, they all, when they sign up, I was like, yeah, we're long-term investors. We believe in David, and he has 20-year track record. He's a billionaire on his own, and they sign up. And then they look at the results 5 years later, I made 20% to cumulative, and my idiot neighbor made 50%, and he invested in S&P 500, and that's hard to take in. So usually they leave. The manager has a bad year or stretch. In terms of quantitative funds, Renaissance gets thrown around a lot because that's the most successful ones. For every successful ones in terms of the Renaissance, there are so many failures that you don't see. Just because they're going to Renaissance doesn't mean Renaissance is going to continue to do it. Maybe Renaissance is having a great stretch. With any long, only, say, good business type things, they have performed superior. Even if they caught up with the S&P returns, the investors would think, oh, it's great, but I would want to go there. That's a clear fallacy of investors' mindset. They usually sell what's underpriced and go to what seems to be producing good returns recently. But that's my gist. But I don't know their portfolio personally, but it's a common investor's mindset that if the investment doesn't work, they move on. That's going to happen with me too. I'm sure some investors are going to think, oh yeah, I'm going to be there for 30 years. And if I produce like in 2 years of bad results or whatever, I can talk about all I want. Well, yeah, I want strongest business in the world. But the stock price doesn't reflect it. But I'm okay with it. I don't know how many of my investors would, but I try my best to educate on what I think, how I perceive, and how my money is the same thing. If that's not good enough, I don't think that's good enough. Yes, that's okay.
I have a question on the regulation behind the licensing.
Licensing of what?
The company licensing. So how you can open like investment company and you start collecting money from people.
Yeah.
What's the capital requirement and the qualification?
Yeah, there are no capital requirements to start as an investment advisor. Either you need to be registered with the state that you operate in, or multiple states if you take on clients from multiple states, or you can just register with the SEC as a one-stop shop. You register with them, you can operate in almost 50 states. But I am registered in 2 states where I have more than 5 clients, and I have clients in other states. They don't meet that 5 numbers in those states. If they exceed that, I would have to register it, or I should have to go to SEC. But there are no capital requirements.
Is there like qualification requirements?
Qualifications is not that much.
Certificates?
Qualifications, basically, you need to pass a standardized exam, either Series 66 and 7, or you need to pass Series 65, which basically is a standardized mechanism of like, you know what you're talking about. But that doesn't mean you're a good investor.
Yeah.
I have a very similar question, actually.
Okay.
Yeah, I was going to ask whether you consider a hedge fund or you consider an investment advisor. And because that means you, as an investment advisor, you basically just charge a fee.
Yes.
You don't get paid off the profits that you make.
You can. You can, as long as the client is a qualified individual. If the client...
So you're considered a sophisticated investor?
Yes.
Even as a...
RIA, yes.
So you charge...
It's nothing to do with the entity, it's to do with the client. Whether the client is in a hedge fund, client's in SMA, it doesn't matter. They know what they're doing, so a management, either the fund or the separately managed account business, they can charge profits.
And the qualification as a sophisticated investor is at $500,000 in assets?
No, $2 million now.
$2 million.
$2 million in assets or more than $200,000 annualized income.
Yeah, I was just going to kind of go back. I think this was presented earlier, but readdressing. So you don't have any constraints as far as allocating any like assets or focusing on companies in different geographical areas. Just kind of hedge, or you're just really focused on they're a good company. They all could be in the U.S. or they all could be in international companies. So that's, if I understood correctly, right?
Yeah, that's right. I go where the opportunity is. I am, as I said, I'm a global investor. Global citizen. It doesn't matter what opportunities in India or opportunities in China or opportunities in the US. We go where the opportunity is. As long as the opportunities are vetted properly and that they satisfy the requirements in terms of safety and adequate returns, we go where the opportunity is. Like I said, I showed you like 3 different geographies, and I probably have investment in 6 different countries now, 6, maybe 7. And I have 17 securities. So yeah, nobody says like where I should invest. It's all discretionary. Manager has a full discretionary authority to invest the capital.
That's why I asked. I see you got the companies you could present were kind of spread out. So
Yeah. Because these are the best business that I could find that satisfies my criteria. Yes.
Yeah, what's your view on index funds? Do you ever invest in index funds yourself?
I have never invested in index funds. There is pros and cons to it. The pros are if you're a know-nothing investor, which means you cannot evaluate one business versus another, talk about superiority in terms of business quality and the price that you pay for those individual businesses. If you cannot appraise a business to see what the value can be, you're so much better off just going with index funds with a low-cost fee. Like I would say like 95, 96, even 99% of the population should be well off just going with index funds. But if you are an investor or focused on owning certain businesses and own it for the long, long, long time, what I do is what I would recommend. Because I think that I can evaluate certain businesses better than some other businesses. So instead of owning like 500 businesses that I don't have any comment on, I would own about 15 businesses that I have some insight on, that I'm capable of figuring it out for the potential future. But I've never invested in index funds before. I would less likely to invest in index funds in the future also. Unless there is a situation comes along, some country goes haywire and I don't have a view on individual businesses in those countries, it's almost a pure bet that the country will come back, all the business can come back. And if they have an index fund to participate in the whole country itself trading for like 5 times earnings or something like that. Time to time things happen. Like Russia, for instance, a few years ago, Russian index gets traded for like 4.5 times earnings, which I never bought. But if I do something like that, that's the kind of thing I'd be buying. If I don't have a great confidence in, let's say, companies in Russia or stewards of capital. But that's a one area that I could potentially do at some point, but I haven't done it.
For your sophisticated investors and your non-sophisticated investors, do you have different investment?
No, I consider my investors sophisticated because they came to me. In the sense that, not in the same sense you think, in the sense that they see something in me that I could outperform the averages.
Well, I'm just thinking because one, you could potentially charge more than another. I'm just wondering, doesn't that matter?
Oh, you mean you're talking about a qualified client versus non-qualified client? In terms of like, one client is rich, the other client is not rich.
Exactly.
Yeah.
So
do I have what?
Do you have a different strategy for each?
No, I have the same strategy. We sell one product, one service, that's it.
You charge them different.
I can. As long as the client's okay with it. But let's say you're a qualified client. I'm going to say, look, this is the 2 different things that I charge. Either I charge 1% flat fee or 0, 6, and 25. Which means like 0% management fee, 6% annualized, I don't get a fee, but 25% after that I get paid. You can pick either one. So it's up to you, it's your choice, the client choice. That's what I do. You can go with a flat fee if you like other clients, other non-qualified clients. But if you think the other part is like attractive, if I do really, really well, the other part is actually better for both of us. If I do a really, really good job for investment performance, 0, 6, 25 is attractive for both of us instead of flat 1%. If I do bad, also it's poor for that because I don't get paid at all. So we're truly on the same boat. So my incentive is to give them the opportunity to choose for themselves. It's completely up to them. My objective is to present them, and they can choose. I can talk about the merits and disadvantages, but it's up to them to choose. Yes, sir.
Actually, you said something interesting earlier. So you know how you come across some of the companies, but you mentioned if you don't feel comfortable with a company within like 5 minutes, there's nothing else you're going to learn. You're going to pass on. So there's so much information out there. What within that 5 minutes you would tackle first?
Yeah, let's say if I come across a trucking rental business, I know what the economics of those businesses should look like, right? What the drivers for those economic variables are. Could be reach, geography, location, segmentation, fleet utilization, so many factors. So I can immediately look at those things. Check. And then there are several competitors, like you probably know Ryder Truck and Penske Truck Rentals. And I've looked at the competition too, because I just want to be sure that I'm picking the right guy than a weaker competition. So if I go into, let's say, a Canadian company, a truck rental company, it'll be easy to look at that. So when I said if I don't know it in 5 minutes, which means I don't have the makeup of the mind, what are the variables I should be looking at in those businesses? If I'm looking at, let's say, a cable company, for instance, the franchising laws are different. Let's say in a country like America versus India. In the US, you have maybe 3 largest cable companies. I'm talking about a broadband internet to your home. 3 largest companies. In most cases, you don't have an option to choose another one. They're like a monopoly, right? And that's an attractive proposition as an owner, because you kind of get some sort of utility type payments, like an electricity. Like you paid $100 a month for internet and cable, I'm keeping getting that's good. Nobody else is going to come and put the pipe next to me and fight for you or fight with me to gain the customer, right? But it's completely different in a country like India. Almost anybody can dig up the street and they're going to lay the lines, which has been happening right now. So the moment that I look at it, that's what I look at it. If I'm looking at the cable company, or do they have like some sort of a monopoly type characteristics where I can see the 5 years, 10 years of potential outcome. 5, 10 years of potential outcome, because we're spending billions of dollars here to laying those pipes, right? I want to be certain to get paid over time. But in the case, let's say, if I'm not sure about the franchising laws, anybody can dig up and then put the line next to it. Basically, he's competing with me, and I'm not going to earn return on capital. And either he would kind of compete with me on the price, right? So we're both going to be losing money. So it's not attractive to be in that kind of environment compared to in the U.S. You kind of get a free ride if you own the Charters of the world, or Verizon pipelines of the world, or Comcast of the world. But those kind of things like jumps out. Now you can see that in the profitability metrics. Like if they have an operating margin, or gross margin of 90%, it shows up. If they have operating margin of 40%, it shows up. And you can see it. You can just look at the numbers, you can decide whether you want to go further or not. The numbers will reveal like much more. If you're somewhat of a sophisticated, you looked at the businesses in a detailed way in some cases. But if you're talking about, let's say, a solar industry, for instance, I have no idea where to start. So 5 minutes check is going to be like a ghost pile. I'm not going to deal with it. Or a biotech firm, like maybe less than a minute. I don't know anything about those. I don't have the history of the background of it. I don't know what kind of products get FDA approval and so on and so forth. It's so binary bets. I'm not interested in binary bets. I'm interested in more certain bets. I'm willing to wait for 10 years, 20 years to get paid, but I need to be certain that that's going to happen. But I can get to participate over the years to see whether what my analysis is coming out as a result. Does it make sense?
Yes, thanks.
Gobinath, okay, Jim.
Yeah.
If you thought that speculation led to an artificial price increase in one of your investments, would you consider selling it?
There's always 2 decisions with that. Just because the price increase, I wouldn't sell it, because I don't want to sell it and keep it in cash. And as long as usually there's an option, because I looked at like a few hundred companies in my file, so I can always know if something is trading for like 35 times earnings or something, and something else trading for 10 times earnings. Yes, it's opportunities to sell that and buy that, but not just on the one metric alone. Not just on the, let's say I own this, it's America in this case. It's trading for 10 times earnings, it goes to 25 times earnings next year. Let's play that, right? It's going to be worth $20 billion at that time. And would I automatically sell it? The answer is no. But probably I would sell it, not for the reason, because it's expensive, because something else showed up, which attractive relative to that one. So that's the sell decision. Not necessarily, they are 25 times earnings, which means it's automatic sell. A lot of times, actually, my biggest mistakes have been selling those businesses on that one metric. I bought it for 10 times earnings, now it's selling for like 17 times earnings or 25 times earnings. It's dumb decision of me. And those are the businesses produce like like multi 10x, 20x returns, which I did not participate in. So I have a scar in my brain that it's gonna pop up every time I do something stupid like that.
So two of the companies that you talked about tonight
Yeah.
were controlled by families.
Right.
How do you think about family-controlled, publicly traded companies?
There are pros and cons to it. The cons are usually the easiest one to find because they're not willing to sell. If somebody, let's say, want to buy those companies, the management and the family don't want to sell it, which is natural. If I own the company, if you own the company, accidentally it was publicly traded, just because somebody else gives one shot at a time, you want to sell it, and you don't have to sell it because you always think 5 years from now you'll make a lot more money just keeping it. Right? As an investor, it could be a detraction in that one particular case. You could realize that value immediately, and you can move on to something else. It's easy for an investor like me to do that, think about that. It's hard for the family to think about that, because family always have a lot of plans, like 5 years, 10 years, 20 years plans. As long as they think about it rationally, in terms of instead of selling it now, 5 years from now, if I can make double of what I make now, I'm completely happy with it. But on the other case, some families they're not just willing to sell it for no reason at all. And that may not be the ideal one. But the pros are plenty. Actually, recently I don't know who the publication is. Recently somebody came up with a study of listed the family-controlled or founding family-controlled businesses far surpass the companies who are agent-run, which means like CEO-run businesses. For the reasons are plenty. One of the reasons they think long-term. They're not looking at this year's earnings and then they cut some expenses. Marketing expenses is the easiest one to cut, which is not going to show up today, but it's going to show up next year's sales and revenues and so on and so forth. So they have a longevity problem in terms of the managerial talent. And the CEO's life in terms of the CEOs is very short. So they want to make a big out of it when they are in prime. So they would want to do almost anything to make their network bigger than after they left, how they want to leave the company. So it could be a disaster in some cases, but it doesn't happen mostly with family-founded companies or controlled companies. But that's not given for everybody. There are well-run, well-controlled, family-run businesses, and they are badly run too. You can look at it, right off the bat, you can see it, how they get compensated, what they have done with the capital, whether they've distributed the capital appropriately. Capital allocation just comes out right off the bat. You can notice it, whether the family has done it right way or not. But the difference is so huge, so you can see it very, very clearly.
Another question, Bill.
Yeah.
So you had mentioned India and China, have been hit on the currency side, and obviously the emerging markets now have been hit on the market side. What's your take on both India and China right now for investment opportunities, and how do you then go about looking for those?
Well, there are plenty. There are plenty of opportunities. I'm constantly on the lookout. The difficulty is easy to find out. The disclosures are not that heavy in terms of what they will disclose in an annual report. And sometimes it's just so damn difficult to even read through the material to see what this business actually does. Like what they own, how they generate profits and all of that. So that's the difficulty part of it. The good part is basically the Indian economy and Chinese economy to a large extent. They're going to grow multiples of what the US is going to grow. Even in those, some industries are going to grow much faster than the whole economy, except like a service-based industry, like financial services or technology, some sort of, let's say, broadband consumption, whatever that may be. There's a huge, huge potential. And they could perform like 2 times or 3 times higher than what the general economy is going to do. But if you're focused on certain pockets of that, let's take about like financial services industry. Buffett has recently invested in a company called Paytm in India. They're basically a phone-based app, like in financial services. And what they have done is nothing short of miracles in the last 10 years that they've done. So there are plenty of opportunities. Indian public has less than 50% of the population has bank accounts, to give you an idea. And almost 85% of the transaction is cash-based. So in terms of the electronic-based potential is unbelievable. The difficulty lies in who's going to be the emerging winner in those pockets. And even if it is remotely close, few companies are going to be the ones, and their price gets pushed into 50 times earnings. So it's not obvious at those prices that the future economic growth of those particular businesses is going to be conducive for an investor. But if you're careful enough, and like I said, Indian currency depreciated 35% this year. So your dollar buys a lot more of those stocks than it used to. So in those one aspect, it's a good hunting ground, but it's not as easy as I just pick up a 10 years annual report. And if you go to America website, they have 12 years of annual meetings recorded live. So basically an hour and a half worth. I basically went through all of them twice. So there's plenty of things you can learn without even having to go meet anybody. And you can go buy a product, you can go to the store, and then you can talk to the employees, how the management treats. You can actually, there's a Glassdoor app, you probably know. You can go and type in the company name and talk about ex-employees and employees. So you can gather so much information, which is harder in cases of emerging countries. One is the feedback loops are very, very minimal, and it doesn't stay in the forum for a long enough time to make a judgment of it. But if you're a careful investor, if you're piling up some of the companies that you potentially would be invested over time to time, countries go into recession or whatever, and some businesses get priced attractively, you can participate in it. But that's what I would do if that's what I do actually. I look at some of the strongest businesses and I follow them for that amount of time. And hopeful that at some of those situations, some of those businesses are priced relative to my level of attractiveness, and I can buy into them.
All right, so I think I'll ask the last question here.
Okay.
What advice would you give everyone? Tools, techniques, habits to create now to be a better investor?
Yeah, if there's one characteristics I would want you to increase, I would say patience is the best one. Patience both in terms of before you buy a business or before you buy a stock, you thoroughly research and you wait for those opportunities to become no-brainer to you. That's a long, hard wait process. And when there's a time comes along, you have to pound it because the opportunities are really, really, really rare, especially the really great ones. Like Charlie Munger says, he doesn't get to where he is going after mediocre opportunities. So that should say. So when there's an opportunity, you prepare your mind and wallets, basically, pockets, checkbook. And when there's an opportunity comes along, you have a pound, and then you just be a long-term investor in that business. That is by far the most underrated attribute, in my view, in terms of investors' mentality. And two, you're all well qualified in terms of you're aware of a lot of tools. You get to study prestigious GW, and you get to listen to some of the prominent investors alive, how they do what they do. And you have plenty of time and tools in your arsenal to focus on what you want to be. But the patience is probably the best one, and analytical rigor. You can take it as fast as you want to go. This is not a 100-meter dash. It's a marathon. Because you're probably investing for your retirement. You're talking about 40 years or so, 45 years or so. You have plenty of time. I want you to focus on the right type of businesses and all some correctly. Yes, ma'am.
Just probably the question related to what you just said. Daniel Kahneman, I'm not sure if you know him, he wrote a book, Thinking Fast and Slow, and he was saying...
Daniel Kahneman, okay. Yeah.
So in that book he was saying that good investing, it's not about experience, it's about luck and intuition. What do you think about it?
No, it's not a luck and intuition. It's a long preparation. there could be some lucky individual who participate in some of those things, but that's not the whole thing. That's a subset, I would say. But you don't have to be really lucky if you just want to be a good sophisticated, like a network when you retire. You can just average index and over like next 40 years, some of your savings. I guarantee that you're all gonna be easily a millionaire. But that's not the problem. But if you're talking about like outsized returns, he probably may talk about the outsized return distribution. Some of them are really, really lucky, which they didn't work for, let's say, but they went with the intuition. But in some cases, some spectrums that I see, they've constantly focused on the right things, and they've made it like really, really, really wealthy over a long period of time. But yeah, he has an argument.
I mean, he developed a big theory about it, and I mean, he provided really good facts that it's all about intuition. And I actually kind of also support him.
Yeah, the intuition.
I recently heard an interview with Warren Buffett, and interviewer asked him, like, why do you like Apple? He's like, I don't know, I just like it.
Well, yeah, he doesn't tell you a lot of it.
I mean, I understand he doesn't tell
he
you
gave
a
some
lot.
very specific examples for Apple. So
Yeah.
on Apple, so he actually mentioned one of the things that Gobi talked about. Didn't he?
Management, yeah.
Management. What else?
The product cycle. Product is.
What was the other?
Cash flow.
Cash flow. Buybacks.
Price setting?
What's that?
Set the price up?
Pricing power, right? So Buffett specifically said actually that the thing is way underpriced.
Today they came out with a new model. Anybody notice?
Yeah.
Do you think the expensive model is more expensive than the previous models or not?
It's more expensive.
Is that what it was?
It's 1,200. So what you say is basically, I use an iPhone incidentally. I'm sure like some of you use iPhones. The stickiness that you have with the Apple products, it doesn't go away. Like, you're going to be I'm not going to say lifelong, you're going to be a long-term customer for those products. Not just a product one-time purchase. The services that they sell through along with it. Services used to be nothing like 7 years ago. Now it produces like $35 billion a year. It's great margin. Talking about 70% gross margin. So when I can tackle that with both the luck aspect. In every investor, even the investment that I make, there is an element of luck. Right? Because I said all the information is in the past, all the value is going to be in the future. So the intuition basically comes from the constant analysis, rigor, and pattern recognition that you've seen before, but very well likely to be applied over time. So it can happen, but I'm sure Daniel Kahneman done his job, but I don't have any view on it. If that is the metric to be in the successful range, I don't agree with that. But if there is a portion of the people that are going to end up with that kind of attribute, sure, it can happen. But in terms of Buffett, he doesn't want to give out this analysis in the CNBC interview.
I mean, he basically gave it anyway.
Yeah, that's it. But we don't think that's important, but it's incredibly important. He doesn't emphasize some points, but incredibly. I even talked about the pricing power very quickly.
That's what I'm saying, yeah.
There's a one attribute you're looking at. Only one thing. Can I raise the product tomorrow? Can I raise the product next year when I come out with a new product? If the answer is yes, my customer's going to love it and still going to pay it, then you've got a great business.
That's Apple.
Well, yeah, actually, this is almost my 10th year iPhone. I actually went away from iPhone for a year or two, year and a half, to Android, and then I came back. Maybe it talks about my personal preference, but it talks about at least some portion of the consumer's behavior from iPhone. But I'm sure a lot of people haven't even moved away from iPhone. If you bought an iPhone, it's just continuously, constantly upgrading every 2-3 years. Yeah, he invested $40 billion. I'm sure he has done the analysis.
Yes. With that, let's clap it up for Gobi.
Thank you.